Hello and welcome to MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. Our discussion today centers around equity funds and more specifically, fund management styles. If you are an experienced equity investor, you may have come across terms like growth and value. If you are just starting out your equity investing journey, let me tell you that among other things, these terms refer to the strategy a fund manager uses to build a portfolio, or in other words, stock selection strategy. Typically, a growth-led investment strategy focuses on buying stocks with high earnings growth potential and not really considering the price you pay for buying the stock. The price that I'm referring to here is not the nominal value you pay, rather the valuation or the market price of the stock relative to its per share earnings. Thus, in growth investing, one is ready to buy stocks at high valuations if there is visibility of high earnings growth. As opposed to this, in value-based investing, the focus is on looking for stocks where the current market price is below its fair valuation based on its potential earnings growth trajectory. Value investors are looking for what's technically known as a margin of safety between the calculated or estimated fair value price of the stock and the current market price of the stock. There is a school of thought which says that all investing is value investing, because why would you buy something where you do not expect the price to move higher, and if earnings growth is not going to keep up, then price will not move higher. Hence, if you buy a stock, you are doing it because you find there is value or a gap in expected fair value versus the current market price. However, this is not always the case, especially in sustained bull markets when markets have been rising unchallenged for a long period of time. Stock price valuations do tend to get ahead of what's considered reasonable. For example, ideally, a stock valued at 50 times price earnings should be able to grow earnings at a rate of 50% a year for the next few years. However, in euphoric bull markets, this doesn't always align. Stocks with high growth expectations get bought into more, and that pushes their valuation above the range of being reasonable. Our current market conditions are similar, where many experts are talking about unreasonable valuations, especially in mid and small cap stocks. A value investor, on the other hand, is not chasing companies with highest earnings growth potential. Rather, they are looking for stocks where the price is low because the market has not been able to recognize the accurate earnings potential. Need not be the highest growing company amongst its peers though. Comparing growth and value portfolios is important for investors. A portfolio of stocks where one is willing to pay an above average price to the earnings multiple with the expectation that prices will go up even further is firmly a growth focused portfolio. As opposed to this, value-based portfolios typically will have stocks which are priced lower than the average market valuations, and the expectation is that the stock price will move higher over time when others recognize the earnings potential of a good quality company. Often, growth-oriented companies continue to deliver high earnings growth rate across market and business cycles. This behavior of consistently high growth is what earns them an above average valuation and keeps the price-earnings ratio elevated. For value investors, the price at which a good quality company is available is likely to be lower than its historical value and also lower compared to other similar companies which are available on the stock exchanges. The reason for this could be recent setback or some recent event that value investors believe has temporarily pulled down price. However, given the history, the financial health, business dynamics, and management capability, among other things, the belief is that earnings growth will return to its original trajectory or its deserved trajectory in a short period of time. And that's when gains in stock price will start to clock in. Investing in growth stocks can yield good momentum returns in periods of bull market. But if there is a sudden change in macro dynamics, like say a sharp rise in interest rates and earnings growth is unexpectedly negatively impacted, then the drawdown or correction in price can be very sharp as well. Hence, a growth-based investment strategy can be volatile across market cycles. Now, the flip side of a value strategy is that you may be stuck in a value trap, which means that while you have an estimated bounce back in earnings growth rate, that event may not occur as expected and the price of the stock you bought into remains low. In high growth companies, remember earnings growth is not under pressure when you're buying. In value-based investing, for several reasons, earnings growth could be under pressure or may have paused due to some negative event, albeit temporarily. Thus, for value investors, the journey in discovering the true value of the stock may be much longer than growth investors. Some investors even consider growth investing to be slightly more momentum and tactical approach, and value investing to be a long-term sustainable approach to investing, which focuses on the company's internal dynamics rather than market factors. So which one should you go for? Clearly, both these approaches are different, and thus having a combination of growth and value styles in your portfolio can work well. For example, consider mid and small cap stocks. Just about 2 years ago, market was focused on growth stocks, and it was the frontline large cap and blue chip companies in the listed stock market which got all the attention and demand. The mid and small cap index went practically nowhere in 2022. In the 2 years since, there has been a recognition of value, and these segments hence outperformed the larger growth-oriented stocks. In 2023 and 2024, there is a lot of discussion around how many segments in the markets are now overvalued thanks to sustained demand for buying stocks and investors' willingness to pay any price. Value fund managers also tend to take larger cash calls if they don't find well-priced investment opportunities in the market, whereas growth fund managers are likely to be fully invested at all times. Thus, in market peaks, you will find more popularity of growth funds where investors and fund managers are more concentrated because that's what's selling more. Value-based funds may even start to underperform in market peaks and sustain bull markets owing to higher levels of cash given the relatively lower availability of stocks at a low price relative to their expected future earnings growth. Given that both approaches can be complementary across different market cycles, having a bit of both may work for the regular individual investor. Having a bit of both is also a good way to diversify your overall equity risk. So next time you're looking to invest in a managed fund, first determine its investment style bias, is it growth or value, and then decide which one you want more of. Hope this video helps you filter through your equity investments in a more meaningful way. Stay tuned to this channel for more on market-linked investing through managed funds.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.